All right, everybody. Welcome back to Strongman Personal Finance. Oh, yeah! So, previously, we talked about your budget and we talked about your personal balance sheet. Now, if you remember when we talked about your budget, we talked about unallocated income. And that's income that you have after you take all your income, you subtract all your expenses, boom, you get your unallocated income. That's the income that you have left over, you have free to start pursuing your financial goals. We're going to go into a lot more depth on what you're going to do with that unallocated income. And it's not buy stocks, bro. So what do you do? Number one, you got to free up the money so you can actually have unallocated income. How do you do that? Well, immediately you can reduce non-essential spending. We talked about this. Lipstick, which I love to harp on, and no, I don't wear it. That's something you can cut out of your budget or get a cheaper brand. Buying video games, spending money on Farmville. You can stop spending money on that immediately, and that frees up money that you can use to pursue your financial goals. The more you free up, the more unallocated income you free up, the faster you're going to achieve your financial goals. If you only free up $10 a month, well, what are you going to do with 10 bucks? Build your savings over 1,000 years? Yeah, that's not going to work. The more you free up, the faster you can achieve your financial goals. All right, so if you don't want to cut expenses, if your video games are too much to cut, your World of Warcraft subscription, well, your only other option is to make more money. Take a second job. Have fun doing that. All right. There's a concept here, and it's called short-term pain equals long-term rewards. What does this mean? It can be a little painful to cut some things out of your budget. Maybe you enjoy going out to eat. I know I do. Maybe you enjoy spending your money on video games. I also do. Well, guess what? If you're in dire financial straits, if you have no savings, if you have no money going towards your retirement, you're going to have to make some short-term adjustments to your budget in order to have long-term rewards. And let me tell you, you can actually get to a place in your life where you actually can spend a lot more money on things you enjoy because you already built a solid financial foundation. But to do that, you got to suffer a little bit of pain, a little bit of hardship in the beginning. I know it's rough, but you got to do it. And it's on you. Nobody cares about your personal finances. The government doesn't care. Yeah, they got Social Security, whatever. However much of that you're going to get in the future. But at the end of the day, no one really cares about you or how much money you have. It's all on you. You need to do what you need to do to take care of yourself and, more importantly, your family, if you have one. All right, so what do? You got to list your financial goals. What do you want to do? There's some goals on here that are essential that you have to have, everybody should have, and there's ones on here that are specific to your specific financial situation. Now, everybody's financial goal should be to build an emergency savings, and we'll talk about that more later. We'll talk about all of these later. You need to build an emergency savings. Everybody needs to have that goal. You need to reduce debt. Over time, you got to pay off your debt. You have to, or you're going to start paying a lot of interest, and that's going to really hamper your chances of improving your financial situation. Short, intermediate term goals, vacation, down payment on a house, whatever your personal goals are, you need to write them down. Write them all down. Doesn't matter what order, just put them down. Retirement, that's another goal. Another essential goal you need to have is to be able to afford an insurance policy to protect your family. And note, I'm not trying to sell you insurance. There's no company sponsoring me, but you actually do need insurance. All right, once you have your list of goals, your financial goals, then you need to prioritize your goals. There's some goals that are really important, and there's some goals that are not important at all. All right, what are important goals? Well, you got some immediate priorities. Number one of the first things you need to do is buy a life insurance policy. All right, this is more if you have a family. All right, if you have somebody that depends on your income, you need to have life insurance. And the reason I say that is if you were to die tomorrow and you have somebody dependent on your income, well, your income's gone, especially if you have no savings. Whoever's dependent on you is in a lot of trouble because their primary earner is gone. So if you have a family, if you have children, you need to buy a life insurance policy. Emergency savings, you need to have emergency savings. Reducing bad debt, credit cards, personal loans, those interest rates are out of control. They will make you poor and they will keep you poor. And the old fat cat bankers are going to be rich off you working your butt off every single day to pay those interest rates. And you don't want that. All right, those are your immediate priorities. Those are the top 3 things you need to do. Then you have secondary priorities, funding your retirement. Most people's retirement's a long ways away, and it is important to start saving for retirement as soon as possible. But if you don't have a life insurance policy, or you don't have emergency savings, or you have a ton of bad, expensive debts, well, you can't really contribute that much to your retirement, all right? You need to first build the foundation, and then you can start working towards the more long-term goals. All right, another secondary priority, buying a house. All right, that can also blend into the next category, tertiary priorities. All right, you got speculative investments. That's like buying Bitcoin, something that you hope will make a ton of money really quickly, but it's not something that you're really, depending on to build your financial plan. All right, vacations, those aren't important. They're important for your mental health, but if you don't have any of the above listed things, you need to build those first before you go on vacation. Remember, short-term pain, long-term rewards. All right, so let's talk about life insurance. How much life insurance do you need? Pretty simple. Take your gross income, we talked about that, that's your income before expenses, and multiply it by 10. All right, that is roughly how much life insurance protection you need. Now, everybody's requirements are different. If nobody's dependent on you, you don't necessarily need a life insurance policy. You may consider getting one because let's say you're young and healthy and you plan on getting married. It's good to get a long-term life insurance policy, especially if you think you might have health problems in the future. Because if you get health problems in the future, your life insurance cost is going to be way higher, especially if you have kids by that point or you're married. Well, now that you have the kids, can't really afford the life insurance and you're in trouble. So 10 times your annual income. I recommend term life insurance. Now we're going to go into a bunch of detail later about the different types of life insurance. But the reason I like term is it's affordable. You can get it for a long period of time, and it gives you a large pay, or it gives your family a large payout were you to die. Now there's some life insurance policies that last your entire lifetime, and like I said, we'll delve into that later. But I don't recommend those, and I'll explain why. All right. So you need to get this life insurance policy to protect your loved ones. Your family depends on you if you have a family. If they depend on you, you need to protect them because if you die, who's going to take care of them? You don't know. You need life insurance. Look into term insurance. Emergency savings. This is one of the foundational aspects of your financial plan. What are emergency savings? They're essential to your financial well-being. They help you eliminate the debt cycle. They are only there for emergencies. Only for emergencies. Going on vacation is not an emergency. You need money set aside to meet any unexpected expenses. Let's say your car breaks down. Well, if you got savings, you can pay it in cash. If you don't have savings, you got to put it on your credit card. That's the debt cycle. For example, let's say I have no savings. Car breaks down. Charge it to my credit card. Pay a ton of interest. Pay it off all the time. Oh, card's finally paid off, but I still have no savings. Oh my God, I broke my foot. Now I have medical bills. Oh, charge it to my credit card. Pay off the credit card over time. Oh, that's finally paid off. Oh, now I broke my finger. More medical bills. You see how that works? You keep incurring unexpected expenses and you don't have any money to pay those in cash. And what happens is you have to charge those expenses to your credit card, incurring high interest rates, and that will kill you. So you need emergency savings to prevent you having to charge your emergency expenses to a credit card or to a personal loan because you're just going to get destroyed by interest charges. All right, so the rule of thumb, and you've probably heard this 1,000 times from other financial planners, you need 3 to 6 months of essential expenses saved away. Essential expenses, paying your mortgage, food, health insurance, things that will keep you alive, utilities. You get the picture. 3 to 6 months. It's really all based on your comfort level. And I'll tell you personally, I probably have 12 months of essential expenses saved away in my emergency fund. That's what makes me feel comfortable. So there's no law that says how much you have to have saved, but at minimum, you need to have at least 3 months. Okay? Please do so. One important note is that your emergency savings need to be in cash. They need to be in cash. Putting your emergency savings in stocks is a terrible idea. That is because if stocks crash or there's a huge, rout in the stock market and you suddenly need your emergency savings, well, there's not that much left because your stocks have lost a lot of value. So I know it's tempting to, want to put this money somewhere where you think you can make more money off of it. But that's not the point of this. This money is specifically here just to deal with emergencies. So build an emergency fund. Thank you. Bad debts. Pretty common sense. Everybody knows what a credit card is. Everybody knows what a personal loan is. Buying a car, buying an expensive car you don't need. These are all bad debts. You don't want to do this. You don't want to charge stuff to your credit card and leave a balance and pay interest charges because the interest rates are ridiculous. The interest rates are higher than any kind of investment return you can get unless you, invest in some speculative voodoo hedge fund. These expenses are going to kill you. You need to start reducing these bad debts immediately. Now, there's all sorts of different ways to do it, all right? You can pay off your highest interest rate credit card first. You can pay off a card with the lowest amount of debt on it. Whatever you want to do, whatever gives you psychological victories and makes you feel like you're actually making an impact, all right? That's what you pay off first. However, you don't want to start doing this until you have emergency savings. I would almost say you have your full 3 months, but if that interest rate's killing you, you need to have at least 1 to 2 months of emergency savings built up before you even start doing this. And the reason I say that is if you start paying off your debt, but you don't have any emergency savings, well, if another unexpected expense comes, boom, you're right back to square zero. So build up a 1 to 2 months of emergency savings before you start paying off your debts. In the meantime, just pay the minimum payments. I know it sucks, but you have to have emergency savings before you start doing this. Retirement. All right, so we already hit the fundamentals. We hit the foundational things you need to do to start building your financial plan. Once you do that, once you have emergency savings, once you've paid off all those credit cards, then you can start really focusing in on your retirement. Now, if your work provides a 401k and they match it, I would recommend you start doing that, even if you don't have emergency savings or that much or you have debt. And the reason I say that is it's free money. Your company matches your contribution dollar for dollar up to a certain extent. All right. That's one exception I would make. Other vehicles to achieve your retirement savings. You got the IRA, you got the Roth IRA and the traditional IRA. And we'll talk about those more later. But basically, they give you, they tax you either at the beginning of when you make a contribution or when you withdraw the money. And if you make a lot of money, eventually you can't use the Roth IRA. Mutual funds. All right. Mutual funds are actually investment companies. You give people money, they use that money, they pool it with a bunch of other people, and they buy whatever investments the mutual fund invests in. All right. You can have mutual funds inside your IRA, and you can have mutual funds inside your 401k. The 401k and the Roth IRA or traditional IRA are just tax advantaged holding accounts. All right. That invest in all sorts of things, but typically mutual funds. I think you need mutual funds that are outside of your IRA and your 401k. And the reason I say that is they're a lot more liquid. Think about this. Let's say you have a ton of money in your 401k and you have no investments in just regular mutual funds. Well, if you're not 59 and a half and you withdraw money from your 401k, you got to pay a penalty. The government will penalize you for withdrawing money early from your 401k and your IRA. But if you just have mutual funds, and let's say the stock market's killing it and you just want to cash in, well, you can actually sell that mutual fund and you don't have to worry about a penalty. And we'll go into a lot more detail in future videos about that. Now, a key thing to keep in mind is that for your retirement savings, it's all based, or what you're investing in, it's all based on your time horizon and your risk tolerance. We'll talk about that later, but basically your time horizon is how close you are to achieving your goal. So if you want to retire in 30 years, you can, afford to invest in more risky assets. If you're retiring in 10 years, you may want to invest in less risky assets that fluctuate a lot less. All right, and then we get to the tertiary goals. All right, these are the things that need to be funded last. If you don't have emergency savings, if you don't have a 401k match, you don't have any bad debts, or if you still have bad debts, you don't want to be funding your tertiary goals. Going on vacation is not important. You need to build the foundation first. It is not a priority. And I'll reiterate this one more time. Short-term pain equals long-term rewards. Short-term pain, long-term rewards. Once you build that solid financial foundation, if you want to spend a lot of money on having fun, you can do that a lot more because you actually have the money set aside and your financial plan is working. Does that make sense? I hope it does. Life's all about sacrifice. It ain't a walk in the park.